Hola, muy buenas tardes a todos.
Good afternoon, all. Thank you so very much for being with us this afternoon. Once again, it's another year. It's going to be interesting to take a look at how our investments have performed. We're going to begin by introducing to you our afternoon speakers. To my left, Sergio Fernandez Pacheco, who is Financial Director or CFO. He's in charge of numbers. He's in charge of ensuring that azValor complies with legislation, complies with CNMV, Bank of Spain, and he is Director of Operations for the company. So he holds a very important position indeed. On my right, Beltran Parajes. I think all of you know him. He also is a founding partner and is in charge with Mission Impossible, which is that all clients, when they want to sell, because there's a drop in the market or for whatever, well, they need to understand that it's time to sow, not reap. So that Mission Impossible is what ensured something that no one has achieved, which is that in 2011, with over 20% negatives, our co-investors did not withdraw. And in 2016, when our fund in azValor plummeted by 20%, he actually encouraged them to get customers to put more money on the table. And this was good in the long run. Sergio and Beltran both, well, it's not me saying this. I don't think it would be valid if it were just me saying. I think in Spain in general, many counterparts say that they really are best in class. They too, they both of them are. Fernando Bernaz is in charge of funds, and myself, we cannot say the same. We manage funds. We do our best. We work really hard. We have experience under our belts. Our savings, of course, are in the funds, but there are many good managers, and we are not among Spain's best. So, apart from what is at stake, which is being here with all of you, well, we also have what Cristiano Ronaldo and Messi know how to do so well, which is be stellar and play as part of a team. Beltran afterwards will explain who we, all of us, are. And without further ado, let's please begin. Our presentation has an objective, which we perhaps will not make. We don't want to speak for more than 45 minutes, but we're going to see whether, in fact, we are successful. And we remind you that you've got these cards. You can ask, write your question, and at the end of the presentation, we will be taking these questions. So let's look at our rear view mirror, and let's see what's been done in azValor Iberia. I don't think that we need to say much. We've achieved good results. It's an international fund, azValor International, and it's good. It's satisfactory. Last year and this year, we've seen worse performance. The rates, well, we would have to actually underscore that for some periods of time, well, this is something that will have to happen. We have 10-year periods, and it's what we call time for sowing. We cannot aspire to harvest better results than the index. And the same for azValor Blue Chips, which was small and now is growing. We, as yet, haven't outperformed the index, but it's a good portfolio, as we'll see afterwards. And here is a slide which we believe is us. We are not brilliant managers who always hit the nail on the head. No, we are persons with 16,000 patient partners, and they are the ones who are performing here. So if you were not with us, we would not be able to generate profits, because at the end of the day, we would have no money to work with. And that, of course, is the advantage that that the stock exchange guarantees. I'm really speaking from the heart of azValor when I say that our clients, our customers, are very patient. And I'm going to give the floor now to Beltran Parajes, who is going to talk about other numbers from a commercial point of view. Thank you, Alvaro, for those introductions, and thanks to all of you for being with us this afternoon. from our business point of view, we can say that 2017 was a good year in terms of assets under management. We've grown by quasi 265 million euros, and perhaps what is most relevant is that over 100 millions come from our international. The SICAV, which we launched 2 years back in Luxembourg, is now over 320 million, and we are beginning this year with over 200 million. Assets under management, under our own management, is 1.645 billion euros. And, well, I would want to say that what we see is that investors who come to us are more qualified, more prepared, and know more about what we're doing. From our customer point of view, we've grown by 45%. We now have 217,000. We have these 5,000 new clients. What's interesting to remember is that the worse the financial news are and how the stock market exchange and so on, well, more activity we have among our customers, which makes us think that perhaps customers do understand what we're doing. The more volatility, the worse news are, well, the more opportunities we have to buy companies at good prices. We definitely want to stay very close to the investor. 50% of our final profitability depends on the client's attitude, and that attitude depends on what the client knows that we're doing. So there's clear arbitration between what we know and what the investor knows, and what we want with these 1,700 meetings, which is the meetings in 17. Well, we want that distance to be as small as possible. And finally, along that same line, in 2017, we've launched a new initiative, which is the YouTube channel, azValor U. We have 1,800 persons who have signed on. And surprisingly enough, only 5 months availability, we have over 90,000 views. And we were impressed by something we saw. Alvaro showed us in Bilbao. It's an interview. 8,000 customers have viewed it. Fernando talking about raw material. 5,000 clients have downloaded it. So it seems to be a good initiative, which is in line with what we try to do, which is ensure that our customers are educated. From the partners' point of view, we have 14. In 17, we brought on board 4 new partners. All of the functional areas of the company are duly represented, and our policy is to bring on board new partners in upcoming years. And this is what guarantees the very solid nature. And as to management team, we are 40. In 17, I would dare say that we have seen a consolidation of the relationship among all of us. Over the past 18 months, we have over 60% of the persons who are working with us. So we've got an offsite which went really well, and perhaps the most salient point is the opening of our London branch. Michael Al-Salim is in charge. It's for analysis and management purposes, and God willing, we'll do more in the future. If there are questions this afternoon, we can certainly go into the specifics. Good. Well, let's talk a little bit now, if briefly, about how we actually go about investing. Many of you already know, so I'm not going to spend too much time on this, and then we will have time for questions, and we can go into the specifics if you so wish. So our investment process calls for generating ideas and analyzing the ideas. So how do you come up with an idea? Every day we read reports issued by brokers. We have about 500 companies in Europe that we've modelized. We track them for 20 years now. There are fluctuations in price, and a dropping price could well be the trigger that gets us studying it. And we also have ongoing conversation with managers the world over. We don't have a WhatsApp group. I read that over the weekend. But we do have very many managers who over the past 20 years have chosen us. They've asked us about Spanish companies, and we ask them about theirs. So, of course, locals always know a little bit more about the local scenario. Investment ideas crop up everywhere. You know, there's many ideas, and here's this funnel. What we do is we select a very few of them. We keep those straightforward businesses that are easy to understand, and these are businesses that face some kind of a problem. This is essential for us. We want to buy as affordable as possible. So there's got to be something that has hit the share price, and we then study and decide that this is a temporary issue. So once an idea has overcome those initial filters, then we perform a preliminary analysis which is very thorough and which basically calls for understanding the company from square one, from the moment it was established, thinking about all the different cycles, all the different geographies. We need to understand its value chain all the way to the end customer. We need to understand who the competition is, those companies perhaps that have earned more of a market share and why, those that are more profitable and those that have more of a margin. We need to understand really, really well what the history is of the managing teams that have been there at the forefront of the sector. And boards also, because you get a lot of clues from different boards, what the incentives are that encourage those managers. What is it that makes one earn more or less money when they're at the helm of their companies, how they're judged. In this preliminary study, we also need to peruse the past 15 years of accounting numbers for the company, because sometimes there are accounting frauds. That's when we have the thief there taking the bag of booty. So after that is studied, we take a decision, Fernando and I do. And the decision is, do we go ahead or not with these companies that we're familiar with? That's a given. This is a very important decision, actually, because the next report is in depth. And this report or study has us really focusing clearly on up to what point will the past, with its causal relationships, up to what point can it be reproduced in the future? So we see a gentleman who is going to be hit hard on the head by a brick. Well, that's unexpected. Some businesses, no matter how good their managers are, cannot do anything about, say, the price of oil dropping. But then there are other variables which can be controlled. And we can see what the performance was in the past in our company vis-a-vis the competition. And we ponder upon whether into the future it's going to be a good thing or not. And then we reach a point which is perhaps the focal point. Once we are here, we understand exactly why in the past whatever happened, happened. And we have a clear understanding of whether the future might or might not be similar to the past. So here you have this gentleman crunching his numbers. Well, that's what we do. We crunch our numbers. We were looking at the consensus of profits, which are implicit for the company, according to the analysts. And from this point onwards, we ourselves decide on the numbers. So we need to know how many physical units the company is going to sell. So if it's Coca-Cola, how many cans are going to be sold at what average price, and what the cost incurred is going to be, in order to really ascertain how much that company is going to earn sustainably. At this point, we also need to be able to cast judgment on the managing team, whether they're skillful or not at selling Coca-Cola cans. Smarter than the competition, earning more money, that is operations. And it also has to do with their skill at investing those profits that have been generated, and whether we as shareholders are number one or number five, because it's not always that shareholders are number one within a company. So this is approximately 100 hours per company for new companies. So we're talking about value investing here, and we wanted to talk about two main risks and an antidote. The first risk, and here's our bitten apple, you can see the first risk is, look at this interesting company. It's a per 7. So the company is at 100. It's a price earnings ratio, which is interesting, which is very interesting for us. So those 100 euros that the company makes are going to become forever and ever 50. That is the value trap, and that is the beating heart of everything we do. We avoid that trap. We do not want to see things through rose-tinted glasses. The second risk at any given point is believing things. As soon as you believe that it's all done and you've been working for 20 years and your results have been good, well, that's the beginning of the end. There's a sentence that says, if you're not humble after you've been investing for 20 years, the market will make them humble. And the antidote we have is, of course, many processes and many limitations, which will surely be talked about during our question and answer period, is a library of errors. This is Fernando and me working for the past 20 years. When we're about to say buy, well, that list of errors pops up, and we believe that this helps us stay focused on reality, and we believe that this serves as a mitigating element for risk, and we believe that this has definitely helped us to stop making some mistakes ever since azValor exists. So how can we spell this out in azValor? Well, we've looked, and our Fondo Ibérico has done nicely right from the beginning. Fondo Internacional also. And we've analyzed all of the companies we've sold, and what happened? Well, we've closed 52 companies. We've earned money. We've made earnings in 90%. We've lost money 10% of the times. So this is a little bit better of a performance than our historical average. So when we make money, we make a lot, and when we lose money, we lose a tiny bit. This is what this slide says. Our profitability is of 14%, which is 15%. That was our specified aim. So the process as of day one is working. Historically, it has worked, and well, it's a way of understanding where we stand and sharing this with all of you. So let's talk about our portfolios that we invest in. So azValor Iberia. In the past, it performed nicely, as we said. At this point, it has 52% potential, which in view of our degree of familiarity or knowledge of the portfolio and companies involved, we believe is attractive. And forward-looking, we, as shareholders in azValor Iberia, or to the shareholder of azValor Iberia, what we want is for markets to move. So there's 80 companies in Spain and Portugal. We can invest in them. We know them very well. We've been tracking them for 20 years, and we know pretty well what the entry and exit levels are. So this fluctuation in azValor Iberia is something that we believe we truly can leverage. In terms of international, I'm going to give the floor to Fernando Bernal. Thank you, Alvaro, and good afternoon to all. Let me talk about azValor International, and let me do so initially very broadly, and then we can zoom in a little bit more into the specifics. So first, as I say, the profitability, as you know, we said at first, is satisfactory, practically 16%, 16, which is better than the reference. But it's important to differentiate between two periods that were very different. 2016 was very good. Profit were of 21%, which was much more than the index. And at the end, well, the fund was basically number one in the ranking in its category. But 2017 has been much more modest. We can talk about 3.0% profitability, so it's lagging behind other indexes. But in the face of this apparently laggard performance, we believe that from within the portfolio, many other things have happened, and there's been major activity. In fact, throughout 2017, there has been, in a bundle of our companies, the ones that we had in our portfolio back then, there have been major hikes, which we have taken advantage of to sell. And, well, we have achieved a weighted profit of 14%. The fruit of those investments have been invested in companies that were plummeting, companies that we owned by growing the weight, or new companies. At the end of the day, the result of all of these actions has been, as we summarize, this is the good news. We've created value, and we have grown the fund's potential, which now is at 110%. So in a year where nothing really major has happened, if you see our statement, well, we're happy because the potential is, frankly, very, very promising. And we see that in the long term, we can expect that this do provide good news in terms of yearly benefits. At this point, it's a fund that is concentrated, only 35 companies, and it's even more concentrated in some areas. The positions are about 60%, and the first 15 weigh 75%. 2/3 are invested in companies that have to do with raw material, and the others have to do with other activities, each one of them unto itself. I would say that there is a common denominator, which is that at the end of the day, these are companies that have fallen greatly, that have dropped in a great way. In our cases, 80% of companies that we have in the international fund accumulate losses from maximum levels of over 55%, which is actually remarkable, I dare say. This is a slide that is perhaps a little bit naive. It is an arithmetical rendering of the potential and time. So the potential, a little bit over 110%, but we're saying 100. And this, for us, is a calculation, but it's a little bit more valid if we comply with our trajectory. And we heard before about a ratio of errors of 15%. Well, the potential is one that we should be able to achieve. And what is perhaps more difficult, this is the question that does not have an answer, is when is this going to happen? At what rate? Clients ask, investors ask, when is the market going to acknowledge the value of my company? Well, what's interesting when we talk about the potential is that that 100% psychological barrier is met, and that's our trajectory. It's fair to say that it is a forward to very good news, independently of time. I think that this is easy to see on this chart, because if we look at the numbers, even in a worst-case scenario, which we think is highly improbable, that the fund's potential take 10 years to actually gel or crystallize, we're talking about an annualized 7.2%. So if this is indeed possibly a very negative scenario, not bad, especially in our current world. Things are expensive, and the kinds of profits we're looking to in other areas are even worse. If the number were to be crunched in 1 year, it would be 100%. I am not going to say that this is actually going to happen, but it's good to remember that nothing is impossible, and especially if we concentrate in a more logical period of time, which is that we talk about between 3 and 5 years. There we're talking about RRIs of between 15 and 26%, which I think are very good, especially in the context.
Ahora brevemente hablando de el fondo azValor Blue Chips. En primer lugar, me gustaría recordar un poco el leitmotiv, por qué lanzamos este fondo en primer lugar. La idea básicamente es que si se produce al final la eventualidad de que lleguemos al límite que nos hemos autoimpuesto de 2.500 millones de euros y cerremos los fondos principales, pues nos pareció, y así nos sugirieron también algunos clientes, nos pareció bien tener todavía un fondo abierto y en el que pues, o bien los clientes existentes vayan acumulando nuevo ahorro y quieran seguir invirtiendo con nosotros, o bien clientes nuevos pues puedan hacerlo, ¿no? Entonces es un fondo que tiene la vocación de seguir abierto y que pueda seguir creciendo cuando cerremos los fondos principales, ¿no? Bien es cierto que bueno, pues con esa idea de fondo y teniendo en cuenta que es un fondo de grandes compañías, siempre hemos dicho que es un fondo que tendría que hacer una rentabilidad un poco inferior a la de los fondos principales, ¿no? Dicho esto, y siendo eso cierto, pues ahora mismo es un fondo que está bastante bien, y a Álvaro y a mí particularmente nos gusta bastante la composición del fondo actual y de hecho pues tenemos inversiones significativas en el mismo, ¿no? Las características principales son que también es un fondo bastante concentrado, todavía un poco más que el fondo internacional. Es un fondo que también cotiza con un gran potencial, también superior al 100%, es un fondo que está barato desde nuestro punto de vista y que representa una muy buena oportunidad de inversión. Y luego, circunstancialmente, porque aunque la vocación a largo plazo de este fondo es que sea algún día un fondo grande, en principio, pues ahora mismo es un fondo bastante pequeño, prácticamente 15 millones de euros, con lo cual, bueno, pues tiene esa pequeña ventaja ahora mismo.
Advantage that it is a fund that allows us now to take advantage of opportunities, this azValor Blue Chip fund. We want this to be an open fund, and when we invest in a company, we always think on the long term, and then you react to the prices, and there are always opportunities that we can take advantage of, and we are doing so. So it is a very interesting fund that I wouldn't lose sight of.
And
to finish, perhaps this is the most important slide or more interesting for you because it's a graphic representation of the main positions of the International Fund. We have decided to do it with pictures because we want you to realize when you look at the settlement value of azValor that you remember that when you invest in funds, you are in part owners of businesses. So to a small extent, you are shareholders of companies that have actual assets, real assets. And in the context that we're in, it's even more important. And I think that this is a very interesting starting point. So this is, we need to bear this in mind. When we invest in companies, that's how we feel, at least, that we're investing in real assets. So in a context where we are at stock exchanges with very good levels, companies listed at high multiples, and with profit margins reaching historical records, we have a set of companies that are good assets, and the most important thing is that they are listed at extraordinary prices. And I would say more. We think that in the future, they will be getting even better profits. Now, that is the main news, and that is something that keeps us very satisfied. And let's take a look at a few examples. First of all, uranium. In this industry, we have invested in Cameco, a company among the ones that are listed, the best company in the industry. We acquired it at a price of $9 when it was listed at $55. When the price of uranium is $20 per pound, it reached a peak of 150. So a lot of pessimism behind this. But the current situation of uranium is quite different than what we could conclude from the narrative. So it seems as if nuclear energy doesn't have much of a future. I'm sure you've all read headlines that Germany is going to do away completely with nuclear energy. France also wants to diversify its sources of electricity. The new Korean government is also thinking about reducing nuclear energy. But the uranium market is growing. So when you do an analysis of the data, you realize that the outcomes are contradictory. In 2017, the uranium market has grown, and we're sure it's going to grow too in 2018. There are many reactors I know that are going to be closed, but there are many others that are being built too. And in fact, there are many more that are being planned pending construction. So this is a market where we have 400 reactors in the world today, and in 2025, there will probably be 510 or 520 reactors. So a growing market, despite the fact that share prices have fallen 80% and the price of the commodity has fallen by 85%. And you will say, well, it looks like you're lonely, you're alone in this vision of the industry. But not so. There are very important examples. For example, the Chinese, they are also not paying attention to the narrative. And what they've done recently is to buy a mine from Rio Tinto, a project for a uranium mine in Namibia. And they've paid a good price for it, even though they still have to build. They still have to invest $2 billion. But when it's built, they will produce uranium at a cost 3 times higher than what we have in our uranium mines. Another example is copper. It is an industry where this is the 3rd year that we talked to you about copper. We talked about this last year too. And we said that we've already sold with significant capital gains. We talked about the Grupo Mexico last year. We've been making 30%, but we still think it has potential. And this is the third year that we talk about copper. We think there's going to be a shortfall of copper in 3 or 4 years. We've gone through a crisis in copper, the second most serious one in the past 250 years. So in 250 years, it is the longest crisis, and when the commodity price has fallen the most. The narrative here is that China has lived a super cycle, and for many years it's been consuming a lot of copper, more than what it needs, and from now on, the demand is going to grow less. The demand is even going to fall. So when we look at this, we see that the reality is quite different. Despite the strong consumption of China in the past few years, the stock per capita accumulated in China is still a fraction of what we have in the West. And I insist, although for 10 years we've been seeing high levels of consumption of copper in China, not to mention other countries from Southeast Asia, Africa, or Latin America, where the consumption is not very significant and it hardly appears in the picture. But meanwhile, for years, there hasn't been any investments in the copper industry in new mines. There are some projects, but you can count them with the fingers of a hand, and it is increasingly more difficult to produce copper. You have to dig deeper. There are less open sky mines and more underground mines. The degrees of concentration is getting worse, and for many years there has been no investment, and at the end there might be a significant deficit. Now, we have invested in this sector in the Grupo Mexico at 10 times profit, in what we think is the best copper asset in the world, because it has the lowest cost and it is a company that has the highest reserves. At a price where the main shareholder of this company, Germán Larrea, if we wanted to buy it from him, he would not sell, because so he wouldn't sell. And the tanker industry, oil tankers, well, here the assets are not that extraordinary, not that unique, but the valuations are. This is a very cyclical industry where the supply then grows a lot and then it falls, and we are investing at 1/3 of the net book value of the assets. This is a super liquid market where there are constant transactions, and it's very easy to calculate the market value because it's very visible. Today, I'm sure that a transaction is being carried out for a second-hand oil tanker. Well, the values of these shares have fallen, and even so, we are buying at a fraction of that value, which today is already low. So we have a double potential that those values will recover, and that the discount that on other occasions was much tighter will also recover. To give you an example, in one of the companies we have invested, we're buying tankers that have a market value of $30 million. These assets at the normal moments of the cycle were worth 40 or 45 million, and we are buying it for 1/3 of those 30 million. We're buying it for $15 million. So valuations that are excellent, as you can see in the slide. So it's almost 2 times profit. And in crude oil and gas, the narrative is that the demand will cease to grow or will even fall because of the electric car. And on the other hand, supply, it looks like the Americans with shale oil have found the golden recipe, and there's going to be abundant crude oil and very cheap in the future. Well, reality we think is going to be different. For many years, we have seen very small investments. Replacement rates of crude oil have reached historical minimum levels, and we also think that the crude oil market is not profitable enough to foster those investments, and that there might be a deficit sooner than we expect. So we're investing in Galp and Tulip, in the Iberian and international funds, valuations of 6 to 8 times profit with the current oil prices. Natural gas, the same story. We have invested in some of the best companies that produce gas in North America at the lowest cost, companies that we know very well, that we have visited in their headquarters in Pittsburgh and that we have studied in depth and we think are doing things very well. Listed not at 7 times profit, but at valuations that are extremely attractive. So we're talking about a portfolio invested in excellent assets in extraordinary valuations, and we think they're going to have even better outcomes than the stock exchanges in general. And now I'll hand over to Sergio. Good afternoon. I'm just going to mention very briefly some aspects of the current situation of azValor, which we think are very interesting for the investors. First of all, high level of activity. I said this at the beginning. We processed more than 17,000 transactions last year, all sorts of transactions. A call center, which is critical for us in caring for our investors, answered more than 11,000 calls, and all of that without any significant issues. We only had 3 cases that gave rise to a claim in our customer service. So most of the transactions were processed to the satisfaction of our investors. Another thing that we measure frequently is the number of visits to our webpage, more than 2 million visits with 250,000 new users last year. Another thing that we're working on and that we've been working on since we rolled out the company is our focus on digitization. We already mentioned last year in our conference that we had made available to you the possibility of carrying out transactions and investment funds through a digital signature with a code that you will get with SMS message. That was extended to individual pension plans in the second half of the year. So at present, all investors can do second contributions or second transactions in mutual funds as well as in pension schemes through a digital signature without having to sign any document physically. Almost 85% of these second transactions are already processed digitally and more than 15% on paper. So that's much more convenient for you, and it's better for us too because we do save a lot in costs. We're more efficient, and what is more important, we significantly reduce operational risk, which there is when you deal with physical documents. And then the regulatory environment. As you know, the asset management activity is a highly regulated activity, not only by the supervisor, national supervisors, but also by international supervisors, in our case with the CCTF, the supervisor in Luxembourg. And most of the year 2017 and the beginning of 2018, we have used to adapt to new rules. One of them is the MiFID II standard, the European Directive on the financial instrument market, which was adopted in June 2014, but has not been transposed to the Spanish legislation until January 2018, and it has 2 clear targets: to improve transparency and the information that all of you receive, and that we have to make available to you and to retailers, and a higher protection for investors. What has that meant for azValor, this regulation, the part that has already been transposed? Well, on the one hand, the need to certify to the azValor team that has a financial dialogue or conversation with investors. They need to have a minimum amount of experience and training that has to be certified. We approved that in our board in December 2017, and we're working to have additional certification by an external supplier in the first few months of this year. On top of that, we have reinforced the controls of the improvements of the procedures followed by brokers, so that market orders are settled efficiently and at the right prices. On top of that, and as a third point, in that another way this MiFID II rule has affected us is that in the pre-contractual information that investors sign when they do transactions with us, we provide more details on all the expenses. Apart from MiFID II regulation, which has appeared more on the press, in May of this year, the new Data Protection Act that comes into force, and that will mean a change in the way we deal with the Spanish Data Protection Agency, the Spanish regulator. We have to do any prior consultation for any project of the company that has to do with the treatment of personal data, and more responsibility in establishing control systems and documentation of all those activities that we develop within azValor and that have some sort of treatment of personal data. So the regulation are very demanding, and we are up to date in that regard. And lastly, just to mention the changes that we've made recently in our prospectus, in the Capital Fund, the International Iberia, and Blue Chip funds. These changes in the prospectus have had as a target, well, basically two targets. One of them is to facilitate access for younger investors to our funds. This is something that we mentioned in earlier conferences, and to facilitate recurrence in the investment. The first change consisted in reducing the minimum investment expense to 500 euros for younger investors, because the minimum right now is 5,000 euros. But for people under 21 years of age, they can start investing with 500 euros. And for all investors, we have also reduced the amount of the additional contributions. That minimum for additional contributions was 1,000 euros, and now it is 500 euros. So investors under 23 years of age can invest with 500 euros, and all investors can do a second contribution to the fund also as of 500 euros. That is all I wanted to say. We're working on a new version of the private area of the web. We hope it will be operational and available at the end of Q2 of this year, and also on the design of a new functionality, which is in line with this target of improving the recurrency of investment. That will be ready very soon. Thank you. Thank you, Sergio. In terms of new funds that will see the light in 2018, two quick notes on that. The first one is a manager's fund. As Álvaro explained in his presentation, throughout the years we've met the very respectable managers with very good results on many occasions in geographical areas, sectors, or disciplines that are complementary to azValor. And for 3 years now, and particularly taking advantage of Álvaro's non-competition year, we spent a lot of time on it, and we thought that it was reasonable in order to diversify our investments and as a complement of what we do to azValor, since these managers cover sectors and geographical areas that we will never have access to, and we wanted to have an exposure to, for example, consumption in Asia or other sectors that we don't deal with, we thought it would be very interesting to create a fund of managers where we put in that vehicle those managers that meet certain requirements that will make it attractive for us to put our savings there. So we are right now hiring the person in the middle, the trainer, we could say, of that team of managers. And throughout the year, we will provide you with more information. We think it will be ready this year. And the second fund is quasi-institutional, I would say. This is an idea that has been cooking in our meetings with institutional investors, where in exchange for stricter requirements or more demanding requirements with investors, for example, money has to be committed for 3 years, but the truth is that the money is going to be 5 or 7 years there, we're going to build a much more concentrated portfolio where we will invest in 10, 8, or 12 companies at the most. We will co-invest with those investors, and in exchange, the remuneration scheme will be a part of the profit obtained by these investors. And with that, I give the floor now to José María Márquez, because the third fund that we want to talk about is a fund. I don't know if you want to introduce it, but we talked about it last year. It's already a reality. It's not really a fund. It's a platform. But why don't you talk about it, José María?
Yes,
I don't think it needs much of an introduction. The fund is a current account, really, where our unit holders have invested more than 1 million euros, out of which 700,000 have already been approved. And on the webpage, you will see these projects, but I'm going to let Jose Maria explain it in 5 minutes. Thank you. I guess that you can hear me. I hope so. Thank you. I read the other day in my agenda one of those sentences that I think can change our lives. What we do for ourselves will die with us. What we do for others will last forever. I think that is absolutely basic for us to bear in mind with our loved ones, but also with everyone, really. And that is truly a long-term view. Our co-investors, as we know, think on the long term. They look for long-term returns, and that is why they give us a chance to collaborate with azValor, which thinks on the long term, more than the 10 years that we were talking about earlier. azValor, which means give value, literally, was born a year ago, and we've already achieved more than 1 million euros that we have collected, that we have raised. I have, on February the 28th, we had 1,013,821. No, 321 with 86 cents that has been already raised. With this, we are doing projects in 9 African countries. We already have 25 projects, beautiful projects. I don't have time to give you the details, but I would love to have time to talk about each one of these projects that we do through nuns, people who are committed in Africa, people who work with the poorest, helping the poorest in the planet, and allowing us to be, apart from co-investors with our managers, they're also allowing us to be co-donors, allowing us to do something beautiful, something that we all believe in. And one day, when azValor Internacional is worth 200, because this is the time to buy in, this is the time to sow. But we hope that you will remember azValor, which can give value in a different manner. Africa Directo is a foundation that collaborates with azValor in this initiative that is called azValor. We are all volunteers. It's an NGO. We make sure that 100% gets to the people who need it. All these stories that we've heard recently about scandals in NGOs are field workers, are nuns. I can guarantee that they don't do any of those things that we hear so much about lately in the press. What they do is to work day and night for the most needy. We as volunteers cover our costs. In a few days, I'm traveling to Congo. After 23 years working in Africa Directo as a volunteer, I still don't have a salary, and I pay for my own trips because I believe in this. When they were talking about companies that they invest in, our co-investors are looking for those who have shareholders are number one. We as number one are our beneficiaries, the people we want to help, the people who deserve it, but also our co-donors. I don't want to say more. I promise not to speak for more than 5 minutes. There you see an article published a few months ago in El Mundo Daily that says that cooperating with an NGO is healthier than 4 days of exercise a week. And I think it's more fun, too, because static bicycles and lifting weights is quite boring, in my opinion. In this article, one of the things it said was, it's a Chinese proverb, if you want to be happy for an hour, take a nap. If you want to be happy for a day, go fishing. If you want to be happy for a year, inherit a fortune. But if you really want to be happy and if you want health throughout your life help someone. And I think that's true. azValor gives us this opportunity, and we'll see each other when it's worth 200. Thank you very much, and thank you to our co-investors and co-donors.
Muy bien, pues empezamos la ronda de preguntas.
Very good. We have time for questions. Questions from you, questions from co-investors on the social media. We're going to begin with many questions which are along the same lines regarding profitability and expectations that investors have. There's a number of questions. They're actually quite similar. My hopes a year ago in International were of 17%. Today it was 1.2. Should I perhaps modify my expectations? Well, this is a very good question. And my answer is yes, you do need to modify your mindset. Your expectations should be a little bit different. It's time to repeat something we say often. The stock exchange can do whatever it will. At any point in time, nobody knows what the stock exchange is going to do. And we invest, but we're investing for 5, 6, 7 years. If you're thinking about International, if you're thinking about azValor, International, oh, it's been many years with Bestinver. I'm sorry about that, says the speaker. It's azValor, obviously.
Son muchos años contra 3, ¿no?
Yeah, I'm sorry, it's many, many years. I do apologize, says the speaker. I do humbly apologize. As I was saying, somebody who invests is somebody who's got to be ready to put up with the bad times. Now, if you're expecting, to achieve a snowball effect, I'm thinking that people trust this team. You need to trust the team, because if you don't trust the team, well, don't invest. If you do, well, it's chapter 8 of Graham's Smart Investor. Everything is against if you think about year on year. After 3 or 4 years, you're botching the job and everybody else is doing a great job. You're going to think, well, this fund manager is terrible. I need another one. But our portfolio, as of 1999, I'm going way back in time, this is where you really had the best possible opportunity of making money. I think 99 was very similar to this current year. I have some slides which are not in my presentation. I want to share them with you so that you can see what it is that we have in azValor International. Yes, it's a very important piece of information. Slide 43, please.
Bueno, aquí vemos que en general está, en fin, ahí vemos un gráfico.
Okay, so here's our graph. It's Buffett indicator, and you can see how expensive or not the stock exchange is. So it goes up, it's expensive. It goes down, it's cheap. Well, over the past 70 years, it's been pretty expensive. Pretty expensive. And this indicator, not that it's a holy grail, it's not a silver bullet, but it's reflecting nicely those signs that told us jump in or not, looking to the long term. But now, please, let's go to slide 42. Our portfolio is basically made up of raw material companies. We see a chart that talks to us about how expensive raw materials are with regards to stock exchange, and we're going back in time 50 years. There have been 3 moments in time, in the 70s, at the beginning of the 2000s, and now when raw materials are abnormally cheap in comparison with the stock exchange, and 3 points where it was just the opposite. We can see that, well, back to average. In other words, the stock exchange does much worse than our raw material. But this chart, a lot of people read into it that there's this like technical analysis. Well, no, it's not a technical analysis. What there is a glaring truth. So please let's go to slide 51. What we see here is 100 years of assessment of commodities, raw materials. We're going back to 17, and well, we're beginning to have statistical evidence, and we see where we stand. But what we see is that the population back in 80 1980 until today. Growing, 45 million persons per year. In the upcoming 25 years, it's going to be 66 million. Every year, an additional 66 million. And there are not enough infrastructures because this is going to happen basically in cities. The population right now, the growth of urban population vis-a-vis the sum total, so people who live in cities, is about 0.9. So one person, new persons born, 0.9 goes to cities. And in upcoming years, it's going to be more than one. So there's going to be many, many more people living in the cities because there's going to be people abandoning the countryside. This population growth, out of control, needs a lot of infrastructure. And we're going to see up to what point we are prepared in terms of infrastructure. So please, I would like to see slide. Please, could we see slide 53? Please, slide 53. According to McKinsey, this is the money you need to invest in infrastructure over the upcoming decade and a half if we compare with the previous 15 years. There had been a super cycle, said people. You know, portfolios, commodities. What people say is, let's see what the detractors have to say. And say, gentlemen from azValor, you're chock full of raw material and you haven't understood there's been a Chinese super cycle, which is over because that was a bubble, and you're going to crash. Well, this chart is really good because there's 5 or 6 additional sources that we've checked, but we thought, you know, McKinsey, we thought was good, but they all say the same. In China, 8 trillion in infrastructure, and there's 14 trillion. So 14 trillion is like 15% less than the GDP of the USA. But in the developed world, USA and Canada, it's the same. The world needs infrastructure. The developed world, especially, no, I'm sorry, the speaker corrects himself, the developing world. But let's look at slide 55, and we see that China, after that super cycle, China is that rhomboid shape in yellow. They're at 30 kilos per person in copper stock. The amount of copper in the Chinese economy. Let's not go to Taiwan and Germany because these are heavily industrialized companies, but the US is 80, 90 as an average. So China is going to be hungry for copper, 4 or 5%, until we, all of us, die, and probably until our children are buried. So it is a point in time which I think very clearly tells us that there is going to be a significant demand of raw material. But as Fernando explained, and I don't want to go into too many specifics, the supply of commodities and every one of those metals, well, it's got that little bit of information. But in general, it's fair to say that it's more difficult because there's less tonnage. There's less nickel, there's less zinc, there's less everything. Rules and regulations and for environmental reasons is more and more complex, especially in those countries where one wants to mine. In developed countries, in Africa, it's different, but there's other types of risks. And, well, demand can change. A copper mine, you know, takes 10 years to build. So we think we could invest in raw materials, uranium, copper, petroleum, natural gas. They're going to be needed for sure. But being able to invest in each one of those raw materials in the company which has most reserves, with least costs, with an owner, with a good balance sheet, well, that's not going to last for a long time. This is a long answer. I'm sorry for this first question, but I think that we're going to be responding to many others. So I stop here. Yes, there's very many, and then we'll talk about raw material. Now we're talking about expectations. We're looking into the future. Someone sounds a little bit disappointed because of International's profitability last year. There's a number of persons making questions or comments saying, how can it be that we are at the end of the ranking in 17? My answer is that in 17, perhaps we seem to be smarter than we actually are. And let's see that in 2018, we're not as dumb as we look. Anyways, there's been other periods over time, and perhaps the most painful, costly one was back in 99, where exactly August 99 until 2000, our portfolios were dropping by 10%, and we had Terra and the dot-coms. They were skyrocketing 10% daily. We seemed to be very dumb. Or at other points when we addressed the issue of a real estate bubble 7 years before the fact. Of course it's disappointing. Of course. Metro Vasesa from 10 to 80, but then it plummeted to 1. And Terra went from 10 to 168, and it dropped to 1. So the thing about investments is that they're difficult. It's tough. It's a tough world here. You can, of course, put your money into the stock exchange and not look at it, but these results are completely normal. We said in one of our quarterly reports, which of course doesn't really do much for us, but when times get tough, the tough need to get going. There's fantastic fund managers in Spain and abroad who are not doing brilliantly. So David Einhorn, for instance, one of the best American fund managers, well, he's got -30 average in the past 3 years and -8 in dollars in February. I mean, it's tremendous. So having temporary results that are under par for the market is natural when you're investing with your eye on the long term. And it's usually when you're thinking of sowing. What I believe is that not everyone, and I speak hand on heart, not everyone has the guts that you need to invest in the stock exchange. To ride the market, you need to be able to grow the position when things are rough, or at least to do nothing. But if you constantly are tempted to flee the market, well, maybe you need to look for another manager whom you trust more, or not think of the stock market. I'm speaking very humbly as I say. We have survived years when our theories do not come through, and suddenly they do come through. So we're not promising that this is going to happen, but what we do need to do is we need to be honest. When we speak out here and now, well, many market operators speak a lot, but there's not much at stake. I mean, if a Morgan Stanley makes a mistake, well, nothing happens to him. Nothing. We have 40 employees. We are partners, and all of the financial savings that we have are in azValor. So when we talk, there's more pigskin in the game, as they say. So apart from that, trusting your manager kind of a thing, I think everything goes against the grain if you compare the last year and a half and so on. I really think that we need to have a 5-year perspective and then say, okay, red, yellow card, how was your performance? So not as smart as in 17 and not as dumb as we seem to be now. And there's an investor who says, would you dare forecast what your results are going to be this year? Well, the fact is no. But let's see what Fernando has to say. You want to add something? Yes, there's more, and it's going to be interesting. No, obviously it's impossible to forecast what the fund is going to do any given year, and that's the key to everything. We need to remember that that's the case. That's true. And of course, the question is always legitimate and always respectable, and we always have to respond, of course. But I would want to say, just to contribute, just to add to what you've said, it's been many years of very good results, and people get used to it. People get used to it really, really quickly. And increasingly, we see that people become impatient when profits are not as fantastic as they've always been. 15% is great. So often enough, what happens is this actually is foreboding of the fact that we're reaching the end of a cycle. We need to bear this very much in mind. All right, now let's talk about philosophy. Here's an investor who has a very interesting question, which is, it would seem that now, yes, our philosophy has changed. If you compare, we're best in value, we're more global, not that local. We said historically we didn't invest more than 2,000 kilometers from a place of residence. So is this a change in the philosophy? Have we increased that type of a risk because of the kinds of investments? Well, we hope that we don't change our philosophy. Philosophy, by definition, doesn't change. We want to buy affordable very good businesses, which was possible back in 2009 when everything fell, and Aciba, a company that at that point in time allowed us to make money and invest in great companies. But right now, our investment philosophy is the same. It's buying cheap. And now in Europe and in the US, instead of having forced sellers, so people who are forced to sell and we buy, what we've had is forced buyers. So remember that the Fed has grown by 4 trillion, just as the European Central Bank and the Bank of Japan, 2 trillion. So all of that money hasn't resulted in inflation in terms of prices, but in assets. Yes, I mean, people are fleeing negative rates. People don't want to buy fixed income. They don't want to buy a bond for 101 pesetas and get 100. No, people are going to the stock exchange. So the prices of assets, which are more similar to bonds, good, stable business, what we like also, are at prices that make it very risky to buy. We have not grown our risk profile. What we believe is we've actually shrunk it. Risk basically is reduced when you buy cheap. Of course, you need to remember other aspects, such as not buy companies that are leveraged because they can go broke, buy companies where things are done well. As to whether we buy local or not, well, we used to say that you know your local entities best, but if you're investing in commodities, distance doesn't really matter. If you want to analyze, say, a clothes chain, if it's in Spain or Massachusetts, whether it's Spain or Massachusetts, well, yes, it does matter. It's easier to analyze, of course, your Spanish company. But if you're talking about natural gas or uranium, I mean, a pound of uranium or a barrel of petroleum, it's the same everywhere. So your analysis is of costs and markets, supply, demand, and our mistake rate in cyclical companies is well nigh zero. Nevertheless, we've been tested. I remember when we bought Secursid Kappa, it was a kraftliner paper. We bought shares at 9-10 euros and they went down to 1. We grew our position and from 1 they rocketed to 30. And in cyclical products, we've made very few mistakes, very, very few, practically none. And distance really is not a factor because the product, by definition, is a commodity. Fernando, maybe you want to add something? No, I would just like to insist that in our short history at azValor, we've proven that we're not changing our philosophy. 2016 was an excellent year. We sold Antofagasta, we sold Rio Tinto, we sold Anglo-American Platinum, we sold First Quantum, and then we bought other companies that have nothing to do and which are similar to others that we've invested in. Vivendi, Ryanair, Peugeot, Savills, Richemont, and they went well, and we've sold again. So if we could choose, well, we would be Schindler shareholders at a PR of 6, but what we want is to buy cheap. Good assets and cheap, not buy good companies. We want to do the other. And when you say we've bought assets that have dropped a lot, the stock exchange is on the up and not us, an investor says, if there were a correction, would our international fund be subject to those corrections, or is there a possibility of differentiating oneself from indexes and other funds? That's an excellent question. And my answer is that in the midterm, I would have to see that our portfolio is going to overperform the indexes. Our portfolio is at half price of indexes. If we see a baseline of 100 in 2009, S&P would be at 400 and our portfolio would be at 550. Another piece of information would be 8 times cheaper because our business and portfolio are not the same, but 8 times is many, many times. Another relevant piece of information is that 82% of the fund's portfolio has dropped by over 50% as of maximum rates. And there's not going to be, we believe, any tragedies in our companies because they're solid companies. So I think that we can't expect bankruptcy, but can expect better results. As to the short term, I like to think about a ship that is on the seas and dynamite is thrown around the boat. Everything around the boat shifts and the boat just sways a little because the boat hasn't been hit. I don't know. I think that maybe the market's not going to do anything. Back in the 70s, this is what happened. Perhaps the market will drop and our companies will grow, or the market will drop and our companies will drop a little bit less. I know that at first, there's dynamite around the boat, so it's loud and everyone's scared, but I don't think that the effects are going to be long-lasting. I think that the degree of dispersion is so huge, and let me very quickly share a slide. It's slide number 47, please, where what we see is this is what's happened. These gentlemen who were so right and asked, how long do I have to put up with this for? People are making money and we're not in azValor. Well, look what's happened. The upwards bound line is all of the money that's gone to funds that invest in everything that the index invests in. And on the bottom line is those who want to have active managers. Now, when this flips, it's going to be huge. And I don't want to be unduly technical, but there are many aspects that need to be taken into account because this is going to be painful for those who are making money now. Liquidity. Michael Al-Salam, for instance, our New York head, no, our London head, I'm sorry, has sent us a number of documents. He has experience and he's seen this before. He's got more of a market approach. He's told us that there are dealers who are confused about the numbers of American futures, about the very little liquidity of some pockets inside the market, and suggestions when things get ugly, everything that's gone up can definitely go down very quickly and very painfully. So I think that these are very, very important data, Fernando. All right, well, let's now talk about investment philosophy that have to do with raw material, and this is the question about raw material. It's a question which we read in Barcelona because it comes to us from the social media. It says, the difficulty in assessing the objective price of a mining company whose quote depends on the price of the raw material extracted. Does this become worse if that mining is gold related? Because the portfolio is very concentrated, very few values, many of them having to do with raw material, and this is published, I would imagine that that assessment is prudential and it's established at a lower range. What criteria are taken into account to determine the objective price and thus know whether we're buying with a sufficient security margin of a mining company and specifically a gold mining company? This is a great question, I have to say. It's actually two great questions in one. We talk about the difficulty in determining a fair price in raw materials companies. I'm not sure I agree. In raw materials companies, this is perhaps when it's easiest because it's a commodity. The product is a commodity. All products from all producers are identical. So it's not like you have a beautiful bike and a pretty clumsy looking bike, or a great song and a terrible song. No. Oil is oil is oil. And our mechanism to determine the objective price of a commodity is something which has very much to do with the Austrian school. We know nothing about the price of petroleum tomorrow or the day after, but we do know something which Mises explains very well, von Mises and other Australians, other Austrians. When raw material becomes expensive, everyone wants to produce it. So oil is expensive, everybody wants to produce oil. What this means is that when the price of the raw material is generated, there's a lot of offer, a lot of supply seeking that potential. And when it's low, that doesn't happen. So you have the cost curve. All producers of a given raw material are there. You list them, you rate them. It's tedious, it's boring, but it can be done. See what the costs are, and then you say, okay, the price of raw material, and it's not a forecast. We're not forecasting where oil is going to be. But if best in class, who has least cost, is going to be earning 10% RRI, as it turns out, the industry would be losing money. These losses would not be sustainable. And our objective price is pretty well a minimum, and that's what we use, conservative or not. We use the objective price of the raw material, copper, natural gas, oil, whatever. That price is going to allow the best operator earn between 13 and 15% IRR. At that price, usually half of the sector loses money, so our price is minimum, and that's how we determine the objective price. Copper, 6,300, we calculate the objective price of our companies. And actually, our error rate has been very low. What happens is we usually sell a little bit soon, but that's how it is. I think we have to be honest and acknowledge that that's how we go about it. So that's what we would have to say about raw material. Now, price of gold. This is different because the price of gold, the yearly flow, if you will, that is exchanged is teeny tiny if you compare it with a stock. Gold is not a commodity, we believe. Gold is money. Gold is good money. Gold is the money that does not alter. Gold is what it is. The dollar, it can evolve. Maybe tomorrow the Fed begins to print more notes and, well, they're worth less. So in this case, this is more complex, but our investment in gold has other aspects to take into account. And I would like, please, to see, this is very interesting, slide 52, please, slide 52. What we see here is the performance of an index. This is a gold mining index over the past 3 decades. We see that over the past 3 years, well, now we're at a low or a very low point. On the right-hand column, we see the value today of all gold mining companies, the ones that make up this index, the Philadelphia Stock Exchange Index. The first we could do away is Clifford McMorran, which is more of a copper company, but all of these gold companies that are listed are worth 140 billion. Which is to say, I remember when we invested in Google, I had 150 bill net cash. So Google, with its net cash, can buy all the leading gold mines. Now, if the index were to plummet, that's 85–90% of a fall, which means that there are companies that have fallen by 95 and the best ones have fallen by 85. Well, we think that it's a good place to go fishing, independently of the fact that it's difficult to assign an objective price to gold. So what we've done is study what lies behind that 20%, and we have simply taken the best in class, those that have an owner, those that do not have debt, with relative weights, and what we do is we're buying at 10 times profits, which we think is good. I mean, good things will happen to us if we buy at this or at 11 times profits. Having said which, gold, the fact that you cannot assign an objective price, it's not to say it doesn't have a value. It's actually the asset that has had a value over the longest period of time. I mean, people have been looking to gold for 5,000 years now. So when central banks are tempted intrinsically to continue to tarnish our currency, as we did in Spain in the time of Philip II, if we don't exit the system without inflation, it's going to be very difficult. So we're at the peak of the bubble of central banks on the one hand, and we have these gold mining companies listed at the lowest price in the past 50 years. Well, it might seem to be a very good time to own a little bit of these excellent companies. Fernando, maybe you want to add something? Yeah, I would just like to insist that this analysis, which is crystal clear and which is based on the Austrian philosophy, but it's also based on logical practice of entrepreneurial activities, sounds theoretical, but is actually very hands-on and practical, and we see this constantly. And this is what explains cycles, actually. As of 2007 and until 2011, the price of copper at very high levels, many projects were launched. And then there was a cooling of the demand, and, well, what we expected happened because of our analysis, which is not immediately, but slowly. We began to see closures, because companies were simply not able to cover costs. So if we think about this, obviously, this calls for all of these very detailed calculations of numbers and so on. And in the long term, it does work very well. What is true is that in the short term, it's worth nothing. For the coming 3, 6 months, 12 months even, nothing. And raw material, actually, well, they face that additional difficulty for many. They're value volatile in the short term and an uncomfortable investment. Definitely what we need to do is be very blunt and say we have got to put up with short-term volatility, and secondly, we have got to have what it takes to think about investments in the long term.
Yes, another question about commodities. Somebody wants to know if isn't there a change in philosophy in the value concept adapted to the new times, because we didn't do this in the past. Well, in the past, commodities weren't as cheap. And the last time that they were so cheap, at the beginning of 2000, most of the market, with the exception of dot-com companies, was listed at 5 or 6 times earnings. These were better companies, companies that were growing with ROEs of 20-25% in what they used to call the old economy. There is no change in investment philosophy. Investment philosophy is buying cheap. And this is what is cheap right now. And I don't know if I can add anything else to that. No, I think we've already given lots of examples. It's not a change in philosophy, not at all. We're absolutely loyal to value investing. And there's something that isn't quite true. I remember that in 1999, when oil prices was at $9, I personally, in my own portfolio, I bought 30% of the fund in oil companies, 25% in low-cost companies, the easy ones with no debt, with owners, the easy ones, and 5% in very high-cost companies, the ones that improved the most in marginal terms when oil prices went up. And that was in 1999 when oil was at $9, so there was value. Then I sold them when the oil price reached 40, and then it went up to 150, which was when Goldman Sachs said it was going to go up to 300. No, but that's not the first time. But this is the only asset that right now is cheap. But I would actually play, because this is the day when customers can ask us anything they want and perhaps even throw tomatoes at us. But let me ask a question to our investors, just to frighten them a bit. And perhaps this gives rise to another question or another remark at the end of the session. One, where are you putting your money in now? You might have your money in your bank current account. I won't have it there. And we've been explaining in the past 15 years that money in a current account is dangerous because a bank might go bankrupt. Supposedly, the state protects up to 100,000. But, well, in a treasury bill, which is not, really short-term, movements of the inflation, slight movements of the inflation, like 2% change in inflation in a 25, 30-year bond can destroy you. You lose 30, 40% in the time you go to the bathroom to wash your teeth and come back. So fixed income is not the time for that either. Except for art, where else can you invest? In the stock exchange. And in the stock exchange, there are companies that have gone from 666, the American index, the S&P, on March the 9th, 2009, to almost 2,800. So bear that in mind. It's Dow Jones multiplied by 4. From 1922 to 82, and multiplied by 4. In 50 years, multiplied by 4. When it multiplies by 4 in such a long time, people who invest in Netflix right now or Amazon or all these companies, they should be aware of this. It does not mean that these are bad investments. We still don't understand them fully, but they should be aware of that. They are invested somewhere everyone has already invested, and it's very difficult to have positive surprises there. So what's left? Where do you put your money? Well, you can have a short-term treasury bills, but the politicians say that there's going to be inflation. Inflation is on the rise. And so when inflation starts, it's not a good idea to do that. But if you don't invest in cheap assets where you're protected from inflation, you run a lot of risk. It's not a matter of frightening our clients, but that's how we see it. So we need to humbly tell the truth, and that's it. But we have to say it loud and clear. At least that's how I see things, Fernando. Yes, I was thinking, and I think we've done this a lot, investing in cyclical companies, in commodities, with bad ROTs. I'm sure that there are many, many more examples. We've done it a lot. It's nothing new for us. We've invested in cement companies. We've invested in the paper industry, in most verticals. We've invested, of course, in crude oil and gas and the steel industry outside Spain. And in Spain, we've invested in chemical companies. In general, we've been doing it always or many times, and and with a lot of success. The target price of copper, what happens if China slows down and the price of copper falls? The price of copper that an extraordinary producer would get 15%, from 3,500 to 3,600. And with regards to China, well, it might have a bad year. China is not going to have a stock of 30 kilograms per capita when we have 100 here. It will continue to consume copper. The risks in mining are different. Risks in mining are that the management team will get into trouble, that it fights battles it shouldn't be in new mines, difficult mines, throw away their money easily because of a high price of copper. And the second risk is expropriation, depending where the mine is. And expropriation doesn't only happen in Africa. It also can happen in Canada, where the tax rate is of 50% in some mines, including royalties. That's the second risk. And if China slowed down, yes, it would be affected. So, yes, it is a risk. But we think that, as Fernando said, we need to make a distinction between narrative and reality. That's our job. That's why you are here. In China, all good news about China are read as if it were a bubble. And all the bad news from China are read as if China is starting to fail. Well, the Chinese, for the time being, invest much more than we do. They work a lot. They haven't promised their populations pensions, health, and education. The Chinese have lots and lots of good things, and their model is not that different from ours. In some aspects, of course, it's different. In some aspects, even horrible. But the economic development model is basically the same. People going from the countryside to the city, saving, investing, working, and increasing productivity. And I think they beat us in that regard. And in some parts of China, of course, there might be an investment bubble, but just in a few small parts of it. So our job is precisely to look through the narrative, and we don't see China collapsing. Perhaps a year, China might slow down a bit, but nothing more. Fernando, we have lots of questions. New goal, a campaign. An investor says the market is penalizing us, we're losing something, and a second investor says that Rainy River is already ongoing and the market continues to penalize it. Are we missing something that we don't know? Another investor from this company also says that if the assumption is still the same despite the situation of the company. Well, for those of you who don't know the story, New Gold is one of our gold mining companies in our portfolio. They have some mines that are working really well, New Afton, Peak Mine, and then they have a very important mine that has been like, giving birth. It's called Rainy River, and it took longer to build and it cost more money than they expected. Now, if we look into it, to just forget about the narrative and look at the numbers, we have calculated with the help of Jorge, our mining engineering expert, what has been the average delay and the average over cost of a gold mine in the past 30 years. And New Gold is exactly in the average. So it's not the end of the world. It's what usually happens in that industry when you're talking about a new mine. When you have others already operational, that's not the case. And this extra cost and delays means that the company had problems, of course. We bought New Gold because that was already factored in the price. Now the shares fell even more. In New Gold, we're losing about 23% of our money in the mark-to-market. And this fall, the company has managed it reasonably well. There was a change in the management team. When we met in Canada 2 years ago, the The chairman was or the CEO was replaced. Michael and Jorge last week went to Miami meeting with the head of the company, and this person is came up with a better incentive system that will make people working in the company more responsible because we're in their hands. And Fun and Sportman took the money, got that money without diluting the shareholder. Instead of issuing lots of shares, they said, I'm going to do a capital increase. I'm going to ask shareholders for money, and I can live comfortably. Well, no, Hans Foreman, I think the New Gold right now has 590 million shares. I think he issued less than 10%, 60 or 70 million. So with a very reasonable dilution, he has been able to start to produce. It's going to produce 330,000 ounces of gold at a higher cost in the first 3 years, but we are buying at 15 times the profit generated and 10 times next year's earnings. But if we make an adjustment, which is in 2 years, the brutal fall in cost of Rainy River, we're buying shares at 5 times earnings. But we're buying at 5 times earnings without taking into account that they have a mine called Blackwater that we value at 600 million, and that in the peak, when it was highest, it was worth more than 1.5 billion. So with all that data, what do I mean? New Gold had a problem, but its share price fell more than the problem, and the problem has been resolved because it's already operational. So, and we have a very close relationship with the company. We've been shareholders for 2 years, and they've seen that we do what we say, we walk the talk, and probably we will significantly increase our position when the market is doing better. We still have a small share of the fund because the company is still quite leveraged. But would you like to add anything to that? On Norilsk Nickel, which is a company that we have in our portfolio, country risk, Russia. What about it regarding this investment? Well, Norilsk is the most efficient producer of nickel in the world. They also produce palladium, a precious metal that is more expensive than platinum right now. And it is a company that is a Russian company managed by Russians, where the shareholders are Russians. Well, it's not the best in the world, but these Russians there's something at stake for them there. I think that it's in the last 10%. 90% of mining companies have done more than what Abramovich and the others have done, and they are the Norwich shareholders. And the company pays out a lot of dividends because they live an expensive life, and they need a lot of money. And so without going into new businesses, they can't really steal very much. They do steal a little bit. We are aware of that. But you see that when they steal in Russia, you can see it. So, but it's something you can calculate. Whilst in the U.S. and Canada, a mine, somebody who speaks great English, and suddenly they do a capital increase of 50% of the issued shares, and you can't do anything about it. That's why we don't invest there. Right now, these oligarchs are fighting, and I don't know if one of them will do a takeover bid of the other. I don't know what's going to happen, but we are relatively comfortable with 75 basis points. Ever since we bought Norilsk until now, it is one of the companies in our portfolio that has performed best. If we made about 25%, it is 25 basis points of the fund right now. Would you like to add anything? No, you explained it very well. Regardless of the fact that that is true, and the numbers are there, these oligarchs, yes, I'm sure they steal a little bit, but they don't throw away the money of the company, because the risk of them overpaying and so on, that is non-existent in this company, or at least it's a very, very low risk. And the important notice nickel was that it was an irresistible asset. The quality of the company, of the assets of this company, is excellent with very high concentrations of metals. We can't see anything like it in the world, and it's very difficult to find anywhere else. Precisely at such a in this moment, we thought it was a great opportunity, and because of that, although the risks were relative risks, even from the point of view of corporate governance, we always had a very low weight. We had a little bit more earlier. Now the company has gone up 30%, and we have less of it. But we've been, but the asset was really unique. Can we value the legal problem at Cameco? Cameco is our uranium company, and there was a claim from the tax authorities in Canada. They were asked to pay a lot of money. I think it was 1.3 million. Well, we met 3 or 4 times already with the CEO of Cameco, and this problem, when it comes to the light, the shares are at $14, and then they went down to 12.5. Now they're at $9. The problem is already discounted in the price. But we talked to law firms to understand exactly the nature of the fiscal fraud, because sometimes there's not only a number that you need to factor into the price, the value of the fine, but, well, the truth is that Cameco has transfer prices between the mines that produce uranium and the Cameco companies that market it. And in light of the evidence of transfer pricing, the lawyers we consulted said that the retailing company was the one that bore the risk. And sometimes, depending on what moment the transfer was done, was in their favor or against them. So they had this claim also in the U.S. They were also asked for a few millions, and the American authorities settled the problem for 200,000 euros. So with the fiscal problem of Cameco, we think that if the worst is announced, it has already been discounted. But if the ruling is similar to the American one that day, Cameco will go up 1.5 euros per share, more or less, which is 20%. So we think it's an opportunity more than anything else. Fernando, would you like to add anything? Somebody who really liked the slide of real assets, he says he's missing something in agriculture, a very attractive industry, which is very well correlated with the other commodities. Yes, very good. The potassium companies we looked at in detail, Mosaic, Potash, even less well-known company. We looked at these. And it is true, on the long term, the world will need to eat. Fertilizers will be needed to generate higher productivity. So on the long term, these will be interesting investments. But right now, contrary to what we see in the sectors where we are investing, where a lot of people are losing money, think that all the people producing in uranium today are losing money. That we think is more interesting than somewhere where everyone's making money. And in potassium, they're still making a lot of money. And potassium knows a lot about it. Perhaps he wants to add something. No, but it's a commodity that, although it has headlines like the other commodities because it's fallen a lot, the peak levels were reached because there was a very important cartel, much more powerful than the oil cartel, a cartel that set the prices and took it to peak prices that it had never seen before. We like to invest in commodities where the cost structure is very stressed. Nordisk nickel, for example, the case of nickel is quite spectacular, not only uranium. Nickel is another commodity that we felt very comfortable with because everyone lost money except Nordisk nickel. practically everyone, and not only in accounting terms, in real terms. In the case of potassium, it's on the other extreme. They've gone through better times, but they still make money. A couple of questions on the possibility of a disruption in commodities. Somebody think it's presumptuous to set such a high potential. And what method do we use? Or in a second investor is asking, what could happen with some of these industries of commodities with the appearance of innovations, as in the case of steel? So the impact of potential disruptions in the commodities markets. Well, we're not presumptuous. We're the same, not better or worse. It's not who has more potential, but what the outcome is, and not cheat yourself. So, in commodities, I don't know what Fernando thinks, but I think it's significantly lower than anything else we do. The press we read every day, well, people read it over the internet, and that business model is almost dead. The traditional business of buying things in a store is dying because people buy things online. The press is read online. Nobody buys physical paper anymore. And to build a bridge or an electricity line, everywhere where bridges, hospitals are needed, the world is not only Europe, the U.S., and Canada. We have Indonesia with 120 inhabitants, China, Africa, India. They're going to need copper still, for sure. Copper for power lines that might be replaced by aluminum. Well, I don't think that's an issue either. So there might be disruption between metals. Perhaps one metal is a better conductor than another one, or one becomes cheaper and their properties are used. I'm thinking about palladium and platinum. But I think that where there is less disruption is in the commodities market, because gas, oil, copper, it's where one starts when you go through a transformation process to build a product for the end customer. Where there is disruption is where people value things differently. Suddenly, the closer we are from the end product and farther away from the commodity, the more potential there is to set yourself apart. It's easier to set yourself apart in a mobile phone. Another one might be very good, another one very bad, but a ton of copper is a ton of copper. But we don't to seem presumptuous. So I think that commodities are less prone to disruptions. I don't know, Fernando, would you like to add anything to that? A very interesting question. What do we see from Castellana 110 that the market doesn't see in an industry like commodities, which is so well known and so old? Very good question. What do we see that the market does not? Well, I don't think we see anything that the market doesn't see, because to tell you the truth, I think the market is seeing this. The market sees this. People that I respect, that I talk to, say, of course, this is going to happen. The issue is, when is it going to happen? It's like the real estate bubble. Nobody said, yes, it's very normal to give 100% of the value of the whole of the house. No, everybody knew that the bubble was going to burst, but nobody knew when. So knowing when is going to happen is what matters. Now, bear in mind that most people in the market, if they buy these things, if they fail, imagine a strategist from Morgan Stanley or an index fund manager that buys Cameco, and the boss comes along and says, are you stupid? It fell by so much. It's not going up. Are you crazy? Why don't you buy Amazon, Google, Facebook? That's happening. I don't want to oversimplify things, but how many people are there in the market of 100% does where there's somebody behind that has something at stake? 15%. Although, I mean, this is just the first thing that comes to my mind. So the other 85, if they make a mistake, nothing happens to them. But the other 15%, they do suffer if they make a mistake. So not having that in the portfolio, because on the short term, this is going to be a problem, a career risk, a risk for my career. And those who have it, because there are many more people apart from us that have commodities, their money is at stake there. I think that is the explanation. Fernando? No, nothing to add. Okay, let's change industries a bit. More punished than uranium and commodities is offshore. Do we have investments in offshore oil? Well, it's a very interesting sector, and we're looking at it with interest. There are offshore companies. Offshore is, I think it refers to equipment producers that help to extract oil from the deepest parts. And they're not profitable sometimes because it depends on oil prices, but I think at 50, 55, it might be profitable, and these companies can start to sell their rigs. Now, this is an industry where the main companies, Diamond Offshore, Transocean, Ensco, are companies that have fallen 80, 90. Right now, we're looking at them. Of course, we need to take them into account, absolutely. And the investment assumption in energy companies, it's not the main position. Exxon Energy is a gas producer in the Marcellus Basin, and they produce gas cheaper than any other company. It's not that they have a good geological situation. Well, they do have one, but the CEO is somebody who had 30% of the company, an investor. He saw what was being done. He didn't like it. The previous management team left in 2013. And this new CEO kicked out the management team, and he became CEO with a salary of $0. So he reduced the overhead significantly, and the result was that the cost were the cheapest in the U.S. But it has something else. The gas in the U.S. is an industry where they've made some huge mistakes because the incentives of producers, of the people who gas companies sent, instead of being by the more money you make, the more I pay you, was the more you produce, the more you get paid. So, the gas production increased a lot, and no company made any money. We did a very revealing exercise. We took the first 40 gas companies, and in the past 15 years, we took only 4 magnitudes. The number of shares had multiplied by 2. In other words, companies had asked shareholders for more money. Number 2, debt. Debt was multiplied from 2 to 5. They had leverage. We took the profit. No profits had been generated, and we said, well, this means greater reserves. Well, there were no greater reserves. So they threw away their capital. Epsilon closed, produced nothing, precisely not to deplete their assets. It's a very small company. It has 0.7% weighing in our international fund. I think it's worth 2 or 3 times what it's worth now. That asset generates from 8 to 11 million in EBITDA. It's listed at 10 times earnings. So that's what the company is worth today. We have all gas production for free. Fernando, I think you told the full story. I can't add anything else to that. An investor who heard the conference of azValor in Bilbao 2 weeks ago, where Álvaro was talking about the gap between production and demand for oil and what impact that was going to have on oil producers. Could you say a little bit more about that? It wasn't too clear what the gap was and why there is a gap between production and demand. It's not that there's a gap. Let's go back to the narrative. There are 2 narratives in the world of oil right now. On the side of supply and the side of demand. On the side of demand, people say we're not going to ever need oil again. we won't need oil again because the electric car is coming. Well, slow down a bit. Yes, the electric car, yes, it's coming in Europe, in China, and the US. We'll see. But there's lots of places where there won't be electric cars. But electric cars are going to give rise to a huge fall of the demand for oil per capita. But there's going to be more population in the world who will want to have their cars. And not all of them will have an electric car. So the level of demand for oil, which is 100 million barrels per day in 5 or 10 years, will continue to be at the same level, 100 million barrels per day. And 110.
Ya estoy preocupado.
Oh, the Juan de Mena 10, that's not my address. You don't know our address. I've said it so many times. Juan de Mena 8, it's no longer that address. But I saw a video recently in the Journal Register Company where they said that everyone knows that the demand for oil will continue to be the same in the future. And then there's another narrative which is not quite true either. American shale has been, panacea, and I think it produces 9.8 barrels per day, and they say they're going to produce 14, 15 million, and those 5 million more are going to absorb all the variation in demand. Well, I'm not a geologist. Jorge talked to the geologists, and with less strength than the argument that I just gave about the electric car, I can say that we have to be very careful about these assumptions because the Bakken that has already started to decline, the main company, which is Oasis Exploration, fell 90%. So let's be careful with that. And then the current Permia, the current panacea, because the market believes that all the deposits are the same, all oil fields are the same, and that they're going to produce a lot. So it's that rationale that is wrong. The narratives is just a linear rationale, and then things are much more complex in real life. So there might be many surprises, and many geologists don't know whether the type curves, which is a production curve of a field, are going to produce what they expect, which is called EQR, estimated ultimate recovery. And it's not very clear that these are true. What is clear is that gas comes out very quickly. So you build a field, a lot of gas comes out, so you recover very quickly a significant part of what you have invested.
But of course, what happens to the tails afterwards, it's not that clear. That supply side, we're going to be just absorbing all of the demand. But then you've got those 15 million barrels a day. That's not much. Not much. You've got conventional production, and it's on the decline, and it's been on the decline for past 4 years because the investments have slowed down. Oil in 2014 slowed down, investments slowed down, and conventionally speaking, over the past 10 years, basically, just by way of information, 200 million barrels more have been consumed and produced. All I'm saying is that neither demand is going to suffer so much from electric cars, nor is supply going to be that affected. So it's the right setting for things to hum along. In any case, in terms of oil, we're thinking about $60. We said when it was at 30, and we continue to say it now. Fernando, do you want to add anything? Yes, I do. I think that this is absolutely essential. Those narratives that Alvaro has just described and which reflect those doubts, demand and supply side, are necessarily bad. Those companies that have low-cost production, $25, $30 per barrel, or sometimes quoted at ×8. So that pessimism with regards to the price of crude is tremendous. I mean, those spot prices today, the market's not believing them. I mean, it's more the burden of proof that it would be up to them, because today spot prices offer what we're thinking of. So oil and gas, what is the EBITDA of tankers? Do you want to take this, Fernando? Well, let's see. In the case of tankers, EBITDA debt is not that relevant because it is very, very cyclical, among the most cyclical that I've seen in my 20 years history, and I've got a couple of them under my belt. But these assets have funding that is very similar to real estate. Actually, they're mortgaged. So we're talking about very liquid markets. We're talking about reliable, easy to follow value, cyclical also, but within reason and very visible. So we need to think more about other leverage ratios. We need to think that it's much more relevant to see the leverage of debt on price of assets, even if it's a depressed market price. And people who fund maritime activities are very, very specialized, and they understand this perfectly. So even though sometimes these things do happen, they're usually not involving generalist banks who are not familiar with the sector. So I would say that it's not really a pertinent question. Yes, EBITDA debt is high because the principals are depressed, and that's because they're not sustainable. So we cannot continue to see this for a long time because the market has got to achieve a balance as time passes. At this point in time, everything is so affordable that as boats rather become older, well, they have to be double checked, and we have to see what the ratios are of fleet prices. Yes, you've answered. It's the impact of new accounting rules with regards real estate, or rather, I'm sorry, tanker leases. It's not going to vary very much. Well, what I mean to say here is that in general, debt is very visible. Yes, but according to new accounting rules, according to these new, they have to be on the books as debt. No, but haulage or boats, they actually rent them to clients. Okay, so why GasLog and not TK LNG? Well, the fact is, TK RNG is a company which we think is healthy. There were some aspects debt-related, and average life of contracts, which seemed reasonable. We talked with experts, and they talked about GasLog. At that point, they were at a very similar price, and we thought GasLog had a younger fleet. So we bought at 16, and we thought that it was a little bit better. And remember also that we're not talking about fantastic. With gas, we bought at 16. It quickly went to 22, 23. Our target was 26, and gas we sold at 22, 23. And why TK Tankers and not TK Corporation? And why not another? I mean, there's a lot of companies. TK Corporation, we thought, had a lot of debt, and those fears were founded. But who knows, maybe at a given point in time, we could take a new look at this. The final two questions about energy. This one I do not understand. I'm sorry, but new nuclear reactors by EV. What is the effect on uranium prices? Yes, the previous client talked about disruption. We're talking about uranium here. There are ways of creating uranium differently. Jorge has been looking at that. We've been following this, but it would seem that there's about 20 years ahead of us before we begin to think about commercial production. I'm looking at Jorge here. Maybe we can go into the details. I wouldn't want to dare say anything because we think that these new ways of producing uranium, which potentially might be different and generate disruption, are very far away from us at this point in time. And the final one about energy, and then we'll go to other portfolios. We talk about opportunities of other sources, biomass, biofuel. My answer is that we're not experts in the product itself. I mean, we analyze the company and we see what the flows are. Well, yeah, there's biomass as a source of energy, yes. But then when you have an idea, and biomass is cheap or whatever, you need to find the right package. You need to find the right package. So it's got to be the right company, and many more things will have to be taken into account. No debt, an owner, positive board dynamics, and our portfolio looks at what we think is best. But I'm sure there are other very interesting alternatives that we're not focusing on. All right, before we go on to Mr. Trump, Serco crisis? Well, Serco is a very interesting company indeed. Serco devotes itself to outsourcing things that the government does. So prison management, hospital management, immigration offices. And the government does it perhaps more expensively and worse. So that's what Serco does. It helps the government outsource those types of activities. This is a very, very dangerous sector because the accounting method for a recognition of income is as follows. I take a contract, which is going to give me 100, I'm going to make 30. So year one, I say 33 sales and 10 profits. I mean, maybe I'm losing everything, but that's not what I write down in my books. So what's happened is that companies in the sector have been very aggressive in their accounting practices, and one after another have flopped. Cabillion went broke. Interserve is about to go down. Capital has fallen by 60–70%, and Serco was the first to fall, the first to go. That was 2.5 years ago. When Serco went down, a number of things happened. First, a manager's team with Rupert Seamus and Angus Cockburn, they, as a team, well, it's not just any team, they multiplied by 7 shareholder values in their previous activity. They were in charge of Agreco, a British company. So the first thing Rupert and Angus did, this is, just for you to get a flavor of what these men do. Rupert told us the first time we saw him, he told us at Serco, accounting is the Bible, and Angus is God. So recognition of method 0, aggressiveness, know what you're earning, and then go to contract. So this team comes in and they turn the corporate culture upside down, which affects everything. Incentives on the one hand, and on the other hand, it increases capital. When the rest of the sector is doing nothing. That's 2 years ago. In the face of the arrival of these persons, the company goes from 80 pence to 140 because the English know that these guys are good and they're discounting positive future results because of these two men. So we are there at about 110 when the company's gone from 600, 700. And we begin to look where they are. We meet with the team. And in fact, the potential Serco market is huge because it's better to subcontract efficiently. The private sector does things better, cheaper. So the potential size was of 300 billion, I think. And Serco sells about 3 billion a year. So the market shares are tiny, and it's not all England. They're also present in Australia and the US. So we invested in the best company in the sector, in a sector which we know is going to undergo turbulences. Now, what happened afterwards? Well, remember the boat in the sea with the dynamite? Well, we begin to see turbulences. Carillion falls. Interserve, 80%. Capita, in principle, the most stable company, and prices were going up by 15%. Well, they go from 500 or 600, I think, to 170. So we see a plummeting. And we begin to ponder, because, of course, Carillion, what happens is a lot of people are left high and dry. I mean, who's going to do this? We're talking about very sensitive services. These are government contracts. So this shakes up the whole sector, and Serco falls. They had done their homework, and they fall from 110 to 85. What happened? Well, what we had to do, of course, is grow our position, of course, because we believe Serco is well perceived by the government with a clean balance sheet. Everyone else has to now increase capital, and that's difficult, and let's see if they're successful. So what happened? Well, government being government, we begin to see the siren song of renationalization. So if instead of having these gentlemen do it, why don't we do it, says Corbyn, and we control. Which is why share price is weakened, but we believe that this is something exceptional. A clean, a good, a well-managed company has underperformed because of problems that were not its fault. And Serco has an asset portfolio of Carillion healthcare products. I mean, they've bought contracts from a bankrupt company at very good prices. And what's more about Serco, and just, for you to understand how deep we are in terms of due diligence, the question for Rupert is, well, you know that in this sector you have a lot of tiny contracts and a couple of huge contracts. If you make a mistake when you're talking about prices, if you make a tiny mistake, maybe the company is going to go down the drain. It's like Técnicas Reunidas or banks when they give bad loans. Well, that's when you get NPLs. And in the case of Técnicas Reunidas or Petrofex, if it's a huge contract and then they have overcost, well, these companies have tight margins. Small errors, 3-4%, will explain that a contract no longer be profitable, but be one that spells losses. And the whole company will be perhaps inching towards bankruptcy, which is what happened to Carillion. Now, I asked Rupert, hey, what happened in the Middle East, where we had an offer for these train transportation? Why did we withdraw? Rupert withdrew. Now, you go to the Middle East and you make an offer. That's expensive. You need to get people there. You're talking about blueprints. It costs us nearly 30 million. And Rupert said, the client, because I think it was Qatar, because of low oil prices, specified these terms whereby whoever takes the contract is going to lose money, but probably a lot of money. My company, I prefer to absorb my 25 million loss. I don't want to threaten my company's life. Fernando and me like to hear this. I mean, we sleep easy. We got Michael's check, and he's a person who's been managing for years in England, and he knows the team. He's, not with there constantly, and he reached the same conclusions. Not the world's best sector, because in fact there's very little money to be made, and tiny errors spell big losses, but it's a growing sector. Despite the noise, which might last for another 2 years, and who knows, if Corbyn were to win, some contracts will be renationalized and it will be carried out by the state. But this is a good company. So these contracts are going to be carried out by the state, because if not, the private sector, I'm sorry, says the speaker. And within that growing pie, Serco is doubtless the best of all. This was a lengthy response, I know, but I think that it explains how we go about our due diligence. I want our co-investors to know really how we invest, how they invest. Fernando, maybe you want to add something? Well, perhaps a summary would be a good idea. No, really, no. I, really have to think hard about a sector which is this hated. I think that there really has been an overreaction. I'm not saying that, that something shouldn't change, like some hiring practices, but really, for everyone, it's good, and we're convinced that we're really on board the best possible company. All right, let's go to Iberica. There's a company which we always said was a mistake by omission, Inditex. We're being asked now, it's fallen by 30%. Well, yes, they're Spanish. And we saw how Inditex multiplied by 5, 7, 10, and not having invested. Well, this is eating humble pie. We continue to make mistakes by omission in our market. But Inditex, if you fall from 32 to 24, that's 25% of a loss. So maybe we should start taking a look at Inditex. Inditex has two stories, I think. Two narratives. They sell some 4 billion in Spain and 10 billion in Europe, and that, well, those are reasonably mature markets with growth rates of profit of 3-4%. But then Inditex is tiny in China and the US. They sell barely 6 billion in all of Asia, 4 billion in the US, and that's peanuts. So those 6 billion could become 12, and those 4 in the US could become 8. And that, of course, would be an additional 10 billion in sales. And for Inditex, it would be very interesting benefits. But in any case, it's a difficult tale to tell, because parallel to all of this, we need to remember that internet has been a disruption. I don't know whether it's going to be a long-term disruption, but online sales explains that other players who before did not have those advantages, well, there's Zalando for you and others. Inditex now is not the only company that has that perfectly polished model, but our gut feeling, and we've got to work on this, our gut feeling is that the model is going to survive and still will grow in Asia and the US. So we have to be very specific. There is an owner, there is a net cash. It was worth 100 million, now it's worth 17. So if Inditex can earn 4 or 5 billion in the upcoming 5 years, well, that's the question that we need to respond to. And then, well, we'll see whether we buy. Investment regarding Coca-Cola partners. You don't want to add anything on Inditex, Fernando? No, thank you. Okay, about Coca-Cola European partners. At the end of the day, you all understand the product. They distribute Coca-Cola. No competition, apart from other soft drink brands. And it is a company that is attractive on 2 accounts. First, it has a lot of fixed debt, which we think is interesting. Coca-Cola has issued paper at a cost similar to that of Treasury, so in negative, that a bond, and they've received 100, and they're going to return 99, or rather 100, and they've gotten 100 plus 5. We think that in a setting where Coca-Cola brings prices up by 2-3 every year, 2-3%, well, that's a source of value. The mark-to-market of that is valuable. And we believe also that in terms of volumes, it's going to grow by more or less 0.5. We're familiar with the fact that Coca-Cola volumes are not doing beautifully everywhere, but we believe that the price will see that variation. There's another very important source, which is synergies as a result of merging all of the bottling plants. There are families behind this, so there's a lot at stake because they want to do a good job, and what the company's doing is 11.5 times profits. So we think that it's not a huge potential, but we do believe it is clear potential, a very solid alternative for the Spanish fund. Fernando? Yes, and finally now, specific portfolio. We're being asked, why are we obstinate in not seeing Google, Amazon's, and so on? And specifically, what do we think about Amazon? No, we'd love to be able to look at them if only we understood them. I've got a person, I don't know whether he's here, and I learned everything from him. And thanks to this person, we bought Google shares when Google was worth 500 billion. They had 150,000 and earned 30,000. So we're paying 12 times if you forgot about the overdebts. This person has insisted, has tried to teach me, but I think that I'm not understanding. Amazon, Apple, they've cost us, but because we don't understand them. You know, when you're investing, you need to really say, I'm out of the game because I don't understand. I don't know how much Amazon is going to make in the coming 5 years. I cannot see it. So we've got money in the funds, our friends, our parents, our relatives, our investors. I mean, we can't, test things out. We need to be absolutely sure. And sometimes you make mistakes, but you don't look for the mistakes. About Amazon, no, definitely. We're very, very humble. These companies, I mean, we don't feel that there's any pessimism. They're not unknowns. They're followed by millions of people. With the case of Google, for a little while, they don't seem to be quoting at accessible multiples. So there's probably other people who are much better prepared. Or kids, my kids tell me it's going to be Google, Amazon, Netflix. And you don't pay attention to them. And they're right. It turns out they're right. Isn't that odd? I read Peter Lynch's book 17 times, and I keep on tripping on the same stone. But, what I tell my son is, I don't understand. I mean, you say it's going to go well, but I don't know how well and for how long. So we need to be honest. Can't do that. Because we have a lot of questions about President Trump and his economic and tariffs policy. We're asked what the impact is going to be of tariffs and how it's going to affect us in our portfolios. Well, policies, we don't have much to say, but everything that lists free exchange is definitely crazy. You don't want to introduce those restrictions. You're going to generate less wealth. It's been beautifully explained. You're an Austrian, Fernando. You know that. No, I think that it's incredible at this stage of the game to be falling into the trap of protectionism. It's bad for everyone. At the end of the day, I think trade really is what creates wealth in global terms. And I think it's actually, the best peace Nobel of all. And it's outrageous. It makes no sense. It's bad for Americans directly. It's bad for American consumers. It's returning to mercantilism. It's centuries of mistakes refuted. It's interesting. And what is the result going to be? Well, I think it's going to be harmful for all, and I think there's going to be a certain degree of inflation in some metals and deflation in some parts of the world. I don't think it's going to last too long because he's so clumsy that I don't think he's going to survive for long. And the possible impact of this peak in inflation and higher rates, my answer is that if, in fact, the U.S. brings rates up a lot, which, allow me please to say, I doubt, and I'm saying above and beyond inflation levels, so in real terms, a number of things would happen. First, the U.S., which has 100% debt, well, you're going to have to pay for that. So if it's a 4.4 deficit and real is 2, well, that's 6.5 deficit. That doesn't seem to be attractive, not off the bat. But if that were to happen, what would happen to S&Ps after having ×4? I think that it would drop a lot. And third, our portfolio, were that to happen, I think it would suffer from the blow. I have to be honest, but I think it would be, in relative terms, much less of a suffering. Maybe that would be the right thing. Bring up the rates, clean the corners, but I don't think politicians want to do that. What they're showing us is, on the contrary, what they're doing is they're sweeping things under the carpet or kicking balls into the future and saying, I'm not going to be here 4 years into the future. Let whoever comes after me deal with it. But I'm not who to analyze this. Fernando, you have anything to say? Our opinion about what Trump says, if the rich pay fewer taxes, it's going to be better for everyone. Well, the thing is, I don't think that we really need to go into everything that Mr. Trump says. Anything that has to do with inequality, and Fernando really has read a lot more of monetary politics. If we're talking about inequalities, it's outrageous because in the world you have handsome men and not handsome men, and you have basketball players who are brilliant, and you have good students and bad students. So inequality is a part of our lives. What is important is that he who has least has a sufficient amount, and that irrespective of your political belief. What you need to ensure is that whoever has the least has sufficient, and that's been achieved by free markets. I don't know what Mr. Trump has to say about taxes or not, but the fact of the matter is that. Fernando? Yes, you bring taxes down, that's good news. We think it's good news. We believe that the market is better than the public sector in general, and definitely returning money to the market and to civil society is good. Now, that tax cut should not be an occasion to actually increase your deficit, because what you're doing is you're kicking, as you said before, the problem into the future for someone else to solve. So if it were more balanced, if it were reducing or cutting taxes and adjusting your public expenditure to more modest levels, well, that would probably be net good news. A couple of questions about macro. How do macro affect the selection process? There's an investor who says we've never talked as much as this time around about macro. I'm not going into the slides. I'm talking about what we've said. Well, macro isn't really important. We buy businesses, and our idea is in 4 or 5 years' time, ensure that the price was right. But at some specific points in time, what is macro? I mean, we don't lose a second. We don't waste a minute in trying to explain macro, what currencies are going to do, if that's macro, or what GDPs are going to do. We don't waste a minute on that. But if you live in Spain and you see they're building 700,000 houses, which is more than France, Germany, and Italy together, you don't need to be a macro expert to say this is crazy. Something's got to give. You don't know macro, but you see 5 central banks fiddling around with their balance. You say, well, what are the consequences going to have on this? Macro, is understanding what's happening and saying, well, this patient seems to be a cancer patient. Or you can forecast and say, oh, this patient is dying in 2 months, or this patient's going to have a heart attack any minute. So we don't do that. We don't think anybody can really predict things automatically. More or less macro, I don't know. I think that the information from S&P, it's not macro, it's just evolution of prices. I think that we try to understand what surrounds us, but with regards allotted time, well, 95% of our time goes to analyzing companies. Macro va de soi, as the French say. You don't need more macro. My students, I don't know if there's any students here, but they've paid attention to us and they've read Human Action and they've concluded that they don't need to know more. I mean, it's a book which in 1,000 pages explains perfectly why things happen. And you know what's going to happen, not when. Not when. That's mission impossible. They never know when the when is going to be. So just read your paper and pay attention and read some reports in depth. And that lets you know more or less what you can expect. It lets you know that the world is going to grow in the emerging part, and commodities are necessary. I mean, we're not that ambitious macro-wise unless we read something in Spain, and it's happening here, or when we hear about China, which doesn't take into account the Chinese savings rate, for instance. I mean, there, yes, we can have different opinions, but this is an analysis which looks at what we know how to do, Fernando.
Sí, de hecho, a ver.
Yes. Sorry to be so purist, but we don't pay too much attention to the macro setting, and we would say it doesn't even exist. It's all micro relations. And macro is just an aggregation, if you will, of micro situations. For example, in the commodities analysis, we're not really talking about macro, but when we see that a company or sector falls a great deal, we try to analyze what has been factored in the prices of these companies. And obviously, then we try to understand those scenarios. And some scenarios, you don't need to know a lot of macro, there are scenarios that are very hard to believe. For example, when copper was at 4,000 euros, the signal you were giving to the market in the copper industry is that you didn't have to invest in a single ton of copper for many years. And that is not macro. It's just a scenario that seemed not very reasonable in any case. In terms of FX for both of you, have you thought of hedging for currency? How do you factor in that in our valuations? Well, our funds don't have derivatives, so it's impossible to hedge for currency. Looking back at 0.15 the euro to the dollar, we might have hedged. But the businesses we have are global companies. If the dollar falls, gold goes up. Or if gold goes up, all gold mining companies go up. Last year, we did 3% of return in euros and 17% in dollars. But it's like a trick, if you will, because if the dollar hadn't fallen so much, Buenaventura wouldn't have gone up so much. At 1.20, 1.22, 23, the euro to the dollar, well, it's not that clear. The PPP, which the purchasing power parity is there. So we could perhaps change the prospectus of the funds to allow for that hedge, but we wouldn't really add very much. Perhaps if we were asked our personal opinion, I might think that the dollar is going to weaken because the situation in the U.S. is facing some problems. So I think it can weaken the dollar. But changing the prospectus and everything to hedge for that when it's fallen already 20%, who are we to predict what's going to happen with the dollar? We talked about this ourselves, and we don't think it's going to fall much more. So I don't think we'll do anything about that, about hedging. An investor wants to know, can you tell him of an error, a mistake that we've made in the international fund? Well, yes, I'm sure there's been a mistake, because we got it wrong in 10% of the companies. There hasn't been a really big mistake. where we've lost 40 or 50% permanently. Right now in our portfolio, to be absolutely transparent and taking the mark to market, there are two possible mistakes. Mandalay, 40 basis points, 0.40, and Marie Brizard, 60 bips. So I might say there might be a mistake because one has fallen 60%, the other 40%, but we don't think they are. I don't want to go into the details of why, but we think that Mandalay is not a mistake. It had the mines, and they had to close one of the mines. They had some problems. We think that the assets are worth more, much more. And in the case of Marie Brizard, it's a company that went through a difficult period in Poland, and with a CEO that was fired on Friday night. And for a company to go back to 12 euros, that I think is easy. And it's an interesting candidate as a takeover bid. So these are two companies that have fallen the most, but they're not really mistakes. And other companies that we've had, one that we could mention as a mistake is TripAdvisor. In TripAdvisor, we said that we tied, and now he calculated it. And we've lost 15 basis points, 15 to 20 basis points. And it was a mistake because we didn't make money, basically. But in TripAdvisor, when we bought, there was a theory, there was two businesses, attraction business, leisure business, and the hotel business. And if everything went wrong in the hotel business, we didn't think we would lose a lot of money. And if it went well, we could make a lot of money. The management team was not very good. And on one of our trips to the U.S., we met the locals, and the locals had a certain advantage. And they explained that the management team, that it wasn't going in the right direction for the CEO to do things properly. Having said that, the company went up 30 to 47 right when the stock exchange was plummeting. So we sold and bought Soleri, and today with Soleri is at 17. We bought at 20. So it's a mistake in the sense that in 2 years at 47, we thought that we were contributing less, that the management team was not doing what they had to do. Then, well, it didn't work out for them. And the tours and adventure business, there is competition not mentioned in the reports, like Get Your Guide Dad Can Hurt It. So all of that to explain that, yes, it was a mistake, I think. We lost 15 to 20 basis points, but we hope all mistakes are like that. Can you think of any other mistake in our international portfolio, Fernando, that you'd like to mention? No. Oh, and we made many. But it's easy not to make big mistakes if you never take on a risk. If you never buy anything with problems, you won't make any mistakes until suddenly the share falls by 50%. So abstaining from debt limits the number of mistakes, but it also limits the number of potential successes. And we've had some successes too. So what we want is to avoid permanent loss in value and clear mistakes like the Apple. We think that we're buying a company with a PR of 7, and we, instead of getting the profit we thought it was going to make, it makes half that, and we never recover the money. That's a big mistake. Okay, the last question, because it's getting late. I'm going to ask Jose Maria to come up here to talk about a case, an example of projects that we are investing in. And meanwhile, a suggestion for a good friend who asked us to include in the subscription reimbursement form a percentage, to put a percentage of that reimbursement for azValor. Yes, I'm sure we're going to do that. Can you give us an example of an investment that we've made with those million euros that we have raised? Yes, can we see the slide with the countries, please? We have 25 projects. I'm not going to talk about all of them, don't worry. We have projects in Italy, educational projects, water projects, agricultural projects to help the most needy with nuns. Madagascar, Angola, we work with the Daughters of Charity. In Uganda, with the Evangelizing Sisters. In Tanzania, with the Little Sisters of San Francis. With the Immaculates in Sudan, a very beautiful project of agricultural programs. In a refugee camp with 300,000 people in the north of Uganda for all the refugees from the South Sudan. And another example to finish that can be seen in azValor U, because in our web you can see many of these projects, and you can see how one of the participants decided to sell a sailboat. It's a very beautiful sailboat. Well, he decided that whatever he got for his sailboat, he will donate to azValor. And that sailboat with that same name, there is a school in Tanzania with the same name of the sailboat. And there are many children that are navigating now, if you will, in their studies and hopes. But another participant who heard us tell the story decided to copy and paste, and a share she had in a golf course she sold, and it has also turned into a project to help the most needy. So there are many ways of doing it with small investments. Also, you don't need to sell a sailboat or the share of a golf course, but with annual contributions of 100 euros or 50 euros, whatever you can donate, or when Iberico is at 200 or blue chips or what have you, you can also, with that profit, make a donation to help the people who help us have a good return, a good life, and we always need to think about the needy. Thank you. Sergio, this is a question for you. Why don't we increase the analysis cost as other management companies do? Well, increasing analysis cost or not, this is a requirement from the new directive MiFID II. That part of the directive has not yet been transposed into Spanish legislation. For us, analysis is critical. It's the highest cost of the company now. It's where we invest the most. The internal team, as well as paying consultants and external suppliers. So some management companies of banks have already announced that they will increase those costs. We have not yet made the decision yet, but we have calculated what it would entail to allocate to the funds the cost of analysis. If funds were to take on the cost of analysis with a volume of current assets, it's 6 basis points. To give you an example, azValor Iberia had a return of 18.99%, so the return would be 18.93%. So it's a part of the directive that has received a lot of attention in the press and the headlines, but we don't really think it's that relevant. We will make a decision when it is transposed. We have, though, changed the prospectus so that the cost could be taken on by the funds, but from the legal point of view, we think that we are protecting the company and the management much better if, when the directive is transposed, until it is we do this with the brokers, we don't think the fund will increase the cost that we could not bear. That was a decision that we thought was what we needed to do. But the decision has not been made. And if we did make the decision, the impact would be 6 basis points, which is not at all relevant, in our opinion. And then we're told, with regards to MiFID II, do we read analysis reports every day? And now with MiFID, that's going to be more expensive. Isn't that too much, very high cost for us? Too high, perhaps? Well, we read analysis, but the cost of the analysis is that of the analysts and the consultants that we have. We read a lot of reports from brokers, but that's not going to be a very high cost, I think. Now, access to companies that we do on our own, that's a high cost. We very rarely ask Citigroup to organize a meeting with the CEO. We send an email to the CEO where we prove that we know the company based on our questions, and they always tell us to meet with them. We don't ask brokers for access. That is what is most costly. And our analyst of azValor talk to an analyst once in a while. Ever since we started, I think I only talked to 2 analysts in my life. So we like to do the analysis ourselves. That's why we know the numbers by heart. But we prefer to study it ourselves. Have you met with them, with brokers? Yes, once in a while. Well, the last 2 questions, and I apologize because there are still many questions, but we don't have time to answer all of them. I, of course, will respond to you personally if you call us or if we meet. But the last 2 questions, one is obviously, what is the difference between investing with Mr. Paranesi or azValor with you? Well, Mr. Paramet, we know him very well. He's a very good manager. So investing with Mr. Paramet is much better than investing with most managers and most indexes. Now, my money is with azValor, and I think he would say the same thing. I can't say much more. Fernando, unless you would like to add something. And lastly, can you give us a reading for people who don't have time to learn about companies, but about value funds to better select managers, fund managers? Well, if the reading is just to choose managers, I think there's a book from Howard Max, The Most Important Thing it's called. I would recommend it because it shows you how manager is more than a return. It's more than that, against the market, with the market. I think it's an excellent book for that. Well, with this, I would like to thank you very much for your patience today with so many numbers and data. Thank you so much for your patience, because we are 50%. The remaining 50% is you. And I would say farewell with a quote from a movie from Rocky: "A standing one assault when you when you don't think you can is changes your life." So we have one assault left. It's not a prediction, but if we can withstand the assault as happened in 2016, we will succeed, because clearly the portfolio is worth much more. Thank you.